Welcome back to the deep dive. I want to start today by asking you to do something a little different. I want you to visualize your money.
Okay.
Not the number on a screen, not your banking app, but the actual, the structure of it. What do you see? Is it a high-performance race car designed for pure speed?
Stripped down, maximum velocity, I get it.
Or is it a bunker?
Yeah.
A fortress, really?
Yeah.
Thick concrete walls ready for a financial winter.
That is such a core tension in investing, isn't it? We all say we want the race car, we want that growth, the big returns.
Of course.
But when the market gets shaky or when life just happens, that bunker starts to look really, really good.
Exactly. And that is the battleground for today's deep dive.
Yeah.
It's the fortress versus the market.
Right.
We're exploring the architectural difference between two ways to hold your wealth. On one side, the race car, the mutual fund, and in the other corner, the fortress, the segregated fund, or seg fund, as everyone calls it.
And we should be clear, this is not just picking product A over product B. No, not at all. It's like choosing between two completely different legal universes. We're looking at what happens when your money leaves the world of securities law, which is where the banks live, and enters the world of insurance law.
Right. So our mission today is to help you, the listener, figure out if you actually need that insurance wrapper. Because looking through our sources, and we've got a lot, analysis from financial planners, documents from Manulife, Sun Life, breakdowns of insolvency acts.
It's dense stuff.
It is. But there are some hidden superpowers you get when you step into that insurance world.
Superpowers is a good word for it. I mean, we're talking about bypassing the court system when you die, creating a shield against lawsuits, and even guarantees that you can't lose your principal.
But, and this is a massive but, hanging over this whole thing, these superpowers are expensive.
Extremely expensive, and that's the trade-off. Is the armor worth the weight?
So let's start with the absolute basics definitions. Because mutual fund and segregated fund, they sound so similar.
They do. They both hold stocks and bonds, but legally, they're completely different animals.
So a mutual fund, what is it legally?
It's a trust. That's a structure. You pool your money with other investors, a manager buys stocks or bonds, and you own units of that pool. It's a pure investment vehicle. Its only job is to try and make money.
Okay, simple enough. Now, the seg fund. I've heard it described as a mutual fund that's been sort of swallowed by an insurance policy.
That's a pretty good way to put it, actually. A seg fund is technically an individual variable insurance contract. The segregated part just means the insurance company has to keep your investment assets separate from their own general funds.
Oh, so that's a safety feature in itself.
It is. If the insurance company goes under, they can't use your money to pay their bills. It's walled off.
But because it's an insurance contract, you're not an investor. You're a policyholder.
Exactly. And that one little distinction changes everything. You could own the exact same Canadian stocks in both, but the seg fund has this legal wrapper around it.
And that wrapper is what we're dissecting. Let's hit the first big feature, the one that, sells these to people who worry at night. The safety net.
Right. This is mainly the maturity guarantee. It's designed to prevent that nightmare scenario.
Which is, what if the market tanks the week I need my money?
Exactly. What if 2008 happens the year you turn 64?
So how does the guarantee work? Is it like 100% of my money back?
It depends on the contract. You'll see these numbers like 7575 or 75100. The first number is that maturity guarantee. If you hold the fund for a set period, it's almost always 10 years, the insurer guarantees you'll get at least that percentage of your principal back.
So if I put in $100,000 in a 75-100 fund, and the market just gets obliterated over 10 years.
You get $75,000 back. You still lose, but you don't lose half. Now, if you bought a 100-100 fund, you get the full $100,000. It puts a hard floor under your investment.
And the second number, the 100 in that example, that's the death benefit guarantee.
Yes. And honestly, for estate planning, this is often the more powerful feature. If you pass away, your beneficiaries get either the market value or 100% of what you put in, whichever is higher.
Let's walk through that. I put in $100,000. A recession hits, my account drops to $80,000. Then I die. In a regular mutual fund, my family gets.
They get the $80,000. The bank says, sorry about the timing. Here's what it's worth today.
But in the seg fund,
they get the full $100,000. The insurance company tops it up. It gives older people this incredible peace of mind that no matter what the market does, their kids are getting at least that original amount.
That is a serious safety net. But what about this other feature, the reset? It sounds like a save point in a video game.
It basically is. It's a great tool, but you have to be careful. Let's say your $100,000 grows to $150,000. You can hit reset. Now your new guaranteed floor is $150,000. You've locked in the gains.
That's amazing. Why wouldn't I just reset it every time the market goes up?
Because of that 10-year clock. Remember, the maturity guarantee only works after 10 years from the deposit date.
Right.
When you reset,
It restarts the clock.
it restarts the clock. So if you reset in year 3, you're locked in for another 10 years to get that maturity guarantee. You can still get your money, but the guarantee won't apply if you pull it out early.
It's like golden handcuffs. You're locking in a higher value, but also a longer timeline.
That's the trade-off. And while we're talking safety, there's also the institutional safety. We all know CDIC for banks up to $100,000.
Right, but this is insurance, so we're talking about a service.
Yes, and Assurus is actually in some ways more robust for larger amounts. They guarantee at least 85% of your benefits. For a death benefit, they'll cover up to $1 million, or 90% of the promised amount.
So if I have say, a $2 million death benefit and the company fails.
Assurus covers 90% of that, so $1.8 million. CDIC caps out way, way lower. So for big accounts, insurance actually has a higher safety ceiling.
Okay, that's feature 1, the safety net. Let's move to feature 2. This seems to be a huge deal in the advisory world. Speed and privacy.
This is a big one. And to really get it, we have to talk about the villain of the story, probate.
Probate. The lawyer and government fee machine.
Basically, it's the court process to validate a will. And in a province like Ontario, it costs about 1.5% of your estate. But really, the money isn't even the worst part.
It's the time. It
Yeah.
has to be the time.
It's the time it takes, 12 to 18 months to settle an estate. The assets are frozen. The bank locks the accounts.
That's just a nightmare. You're grieving, you have bills to pay, and the money's locked up for a year and a half.
Exactly. But with a segregated fund, because it's an insurance contract, if you name a beneficiary, the money bypasses the will. It bypasses the estate.
It bypasses probate.
Completely. No 1.5% fee, no 12-month wait. The insurance company usually pays the beneficiary within 2 weeks of getting the death certificate.
2 weeks versus 18 months.
It's a massive difference for the survivors. And there's another piece here. Privacy.
What do you mean?
Probate is a public process. Once a will is probated, anyone, a nosy neighbor, a scam artist, can go to the courthouse and see exactly how much you had and who you gave it to.
I never thought of that, so it's all public record.
All of it. But a seg fund payout is a private contract. It never touches the public record.
Okay, but I have to push back here. You can bypass probate with bank products too, can't you? If I name a beneficiary on my bank RRSP.
You can, and that's a key point. For registered money, like an RRSP or a TFSA, yes. Naming a beneficiary at the bank also bypasses probate in most provinces. So on that specific issue, they're tied.
So where's the advantage then?
The advantage is for your non-registered money, the cash accounts. You generally can't bypass probate with a non-registered mutual fund at a bank. If you have $500,000 from selling a house sitting in an investment account
It has to go through the will.
and pay the 1.5% probate tax and wait the 18 months. But if that same cash is in a segregated fund, you name a beneficiary and it skips the whole process.
That's a huge distinction. So for money outside your RRSP and TFSA, the seg funds becomes this really powerful estate tool.
It really does.
Okay, let's move to superpower number 3. The Iron Shield. Creditor protection. This is for the business owners, the doctors, the consultants.
This is where that legal distinction becomes, well, a literal shield. But we need to separate this into 2 scenarios, bankruptcy and then just regular lawsuits.
Okay, bankruptcy first. If I go bankrupt, does it matter where my RRSP is?
For the most part, no. Federal law protects your RRSPs in a bankruptcy, whether they're at a bank or an insurance company.
But there's that clawback, right?
Yes, contributions in the last 12 months can be clawed back, but the bulk of your retirement savings are safe in either place.
Okay, so tied on bankruptcy. What if I'm not bankrupt? I'm just a business owner who gets sued.
This is the danger zone. If you are solvent but lose a lawsuit, a judge can order your bank investment seized to pay the settlement. Your bank RSP might even be up for grabs.
But not the segregated fund.
No, because of provincial insurance acts. If you have a seg fund and you've named a family class, beneficiary, a spouse, child, parent, that money is generally exempt from seizure by creditors.
Wait, really? I could lose $1 million lawsuit, but the $1 million in my seg fund with my kid's name on it is safe.
In general, yes, it's impenetrable. The main exception is if you do it in bad faith. You can't move the money on Tuesday because you know you're getting sued on Wednesday.
Right, that's just fraud.
Exactly. But if you set it up years before trouble hits, it's a fortress.
Now, our sources pointed out a geographical twist here. This shield isn't as critical everywhere.
That's right. If you're in Alberta, BC, or Saskatchewan, they've actually updated their laws to give bank RSPs similar protections.
So a dentist in Calgary is pretty safe with a bank RSP.
Correct. But if you're in Ontario or Quebec, it's a night and day difference. In Ontario, your bank RSP can be seized if you aren't bankrupt. An insurance RRSP cannot.
That's massive. That feels like a vulnerability a lot of people in Toronto or Montreal probably don't even know they have.
They don't. Not until it's too late.
Okay. We've sold the fortress. We've got the safety net, the estate planning benefits, the lawsuit shield. It sounds perfect. Everyone should have one. So, go ahead. Ruin the party. What's the catch?
The catch is simple. All that armor is really heavy, and it's expensive. We need to talk about MERS management expense ratios.
Give us the damage. How much more are we talking?
Oh, a typical mutual fund in Canada might have an MER of, say, 0.5% to maybe 2.5%. A segregated fund, you're starting at 2.5% and going up. You'll see fees of 3, 4, even 5 or 6%.
Wow. So double or triple the cost.
Easily. That extra percentage or two is the insurance fee. It pays for all those guarantees and protections we've been talking about.
And we know what an extra 2% does over 30 years. It's not just 2%. It's the compounding. It's destructive.
It's devastating to long-term growth. Our sources had that great Susan versus Mark example. It shows how even small fee differences over time can cost you hundreds of thousands of dollars.
So by buying the fortress to protect your money, you're actually shrinking the amount of money inside it over time.
You're trading growth for safety. You are paying a very high premium for certainty.
Now, since we're recording this in early 2026, there is some good news on the transparency front coming up.
Yes. Later this year, December 2026, regulators are bringing in total cost reporting, or TCR.
So no more hiding the fees.
Exactly. Your statement will have to literally split it out. It'll say you paid X for the investment and you paid Y for the insurance. I think a lot of people are going to be shocked when they see that Y number in black and white.
It'll force them to ask, is this guarantee really worth $3,000 a year to me?
Right. And for some, the answer is yes. But for others, it'll be a wake-up call.
There's one small tax benefit for seg funds we should mention, the flow-through of capital losses.
Right. It's a bit technical, but in a mutual fund, losses are trapped inside the fund. In a seg fund, because it's your own contract, those capital losses can sometimes be allocated directly to you.
So I can use them on my personal tax return to offset other gains.
You can. It's a nice little feature, but honestly, it rarely makes up for the massive difference in fees.
So we have the growth warrior with their low-fee mutual funds,
Right,
and the fortress builder with the segs funds. Is there a middle ground?
the smartest way to look at it is probably a life cycle approach. You don't have to pick one team forever.
What does that look like?
When you're young, you want low fees, you want growth, you have decades to recover from a crash, you stick with the banks, the low-cost funds.
You're the race card.
You're the race car. But as you get older, as you approach retirement, you have more to lose and less time to make it back. That's when you might start shifting some wealth into the fortress. You accept the higher fee because now you actually need the guarantees and the estate features.
So it's about the right tool for the right season of life.
Exactly.
What about the other safety options? Like, why not just buy a GIC or an annuity?
They're different tools for different jobs. An annuity is like buying a private pension. You give an insurer a lump sum, they pay you for life. The pro is you can't outlive your money.
And the con?
The money's gone. There's no liquidity. You can't get that capital back if you need a new roof.
And a GIC.
A GIC is pure safety, but you have longevity risk.
I might live too long for my money.
Right. You might run out. So one of our sources suggested a hybrid approach. Use an annuity to cover your basic bills, food, housing, and then use GICs or investments for everything else, and maybe a seg fund for the money you specifically want to pass on.
I like that. Building a toolkit, not looking for one magic bullet.
Exactly.
So let's bring it all home for the listener. I'm sitting here looking at my investments. How do I decide between the fortress and the market?
It comes down to one question. What is your primary fear?
Okay, walk me through that.
If your biggest fear is running out of money because high fees and inflation ate all your growth, you belong in the market. You're a growth warrior. You accept the risk for the reward.
But if my fear is external,
If your fear is a lawsuit taking everything, or your family fighting over your will in a public courtroom, or a market crash wiping you out just before you die, then you fear loss and chaos. For you, the fortress, the segregated fund, is worth the price.
It's expensive armor, but it works.
It does. And if you're that business owner in Ontario, that 2% isn't a fee, it's an insurance premium for peace of mind.
I want to leave with one final thought that really jumped out at me from our sources. We live in a world where everything feels so public, so digital,
Feels that way, for sure.
and we think of investing as just about making money. But there's a real value to what you could call legacy privacy. With a seg fund, your final wishes are a private contract, no public record. In an age of data leaks, maybe that privacy is the ultimate luxury good.
For some people, that's absolutely priceless.
And that is where we will leave it for this deep dive. Whether you choose the Fortress or the race car, just make sure you know what you're paying for and why. Thanks for listening.
Stay curious.